guest. Steve is the Chief Executive Officer of Latera Communities. He has a background that includes senior executive and principal level positions within real estate, private equity, land banking, and lot development companies. This experience plays out really well in building horizontal apartments. So, Steve, welcome in.
Thanks, Patrick. Nice to be here.
Yeah, nice to have you here. I know we just finished up with Danny on some amazing conversations around sort of the buyer expectations and the trends and demographics, population growth, and all those things. You were here in studio listening in. What were your thoughts?
First of all, his company is very impressive. I mean, they are kind of the gold standard as it relates to the economist in the market. So, you know, people take him seriously, as I do, and I think his analysis of where the market is and where it's been is right on. I think the interesting thing, which you said you don't do projections, is where it's going. Of course, that's the big question.
Well, I'll let you do the projection.
We can talk about that.
So tell us a little bit about who you are, what you've been working on, because I know that you're doing some things that people haven't done before.
Yeah, and so first a correction. My company, and it's very funny you should say this, my company actually is not called Latera Communities. It's called Terra Lane Communities.
Terra Lanes.
But this was a debate with my partners. I did not want to call it Latera Communities. They did. So we settled on Terra Lane. So it's kind of funny you should mention that. But in any event, what we did is we started the company in 2019 effectively to build apartments. And it was apartments that were atypical at the time, this kind of one-story, detached 1- and 2-bedroom apartments. So to be distinguished from a traditional, call it build-for-rent community, which was more, call it homes, you know, 2 to 3 or maybe even 4-bedroom homes, 2-story attached garages. That's not what we're doing. Those are designed for family renters. You might even call them pre-home buyers.
Okay.
And what we're renting to is a demographic that's a little bit different. These are apartment dwellers, almost exclusively. And they fall into 2 primary categories. Category 1 is a millennial renter. Category 2 is a moved-down empty nester. And Danny did a good job explaining that person. Maybe they can unlock some equity from their home and live in a fully maintained community by somebody else. So we've targeted those demographics, but what we're not targeting is families. So we're not generally attracting a couple with children, a single person with children. Occasionally they will join our community or rent from us, but generally speaking, that's not what we're getting to.
Yeah. What are some of the things that you're learning about going through this process? I know this has been, you're carving new ways, so.
Yeah, so learning, it's a great question. I came from the analytical side, so I did something similar to what Danny did, although a little bit different. And what I've learned most is that this product that we've become a part of and was created by others has generated a spark in the market that no one anticipated, including me. I was doing the analysis for a lot of the builders and developers that were doing this, that were operating and actually developing the product. And so when an opportunity came along for me to join on the principal side, being a developer operator, I said, I think there's something here. And in the last 2 years, what I've seen has been remarkable. I mean, just the interest, not just from the investor community, but most specifically from the renter community is what has been absolutely surprising to me. Pleasantly, of course, because I'm benefiting from that as a developer and owner of these communities, but that certainly has been the biggest surprise.
Well, and going back to the demographic, let's go back into that. You mentioned apartment dwellers. Tell me more about that ideal demographic and how you go about it.
Yeah, so it's kind of, again, very similar to what you might find in a traditional apartment community, but they generally, I call them premium renters, not luxury renters. This isn't somebody that's going to rent a high-rise in Scottsdale or Tempe. This is somebody that might, in a traditional apartment, say, well, I want to be on the ground floor because I'll get a yard, or I want to be on the top floor because I'll get a view. And they're willing to pay for it. They've got a little more income. They consider themselves premium renters. They would otherwise be renting a premium unit in a 2 or 3 or 4-story walk-up. And instead, they're happy with our community, which I should describe. What we're doing is these 1- and 2-bedroom apartment units effectively are detached. The 1 bedrooms actually are paired in one structure. The 2 bedrooms are completely detached. But all of the units have their own yard, private fenced yard. You can have a barbecue. There's a dog door in every one of our units. You can have a pet. You don't have to rush home by 5 to let your dog out. Your dog can get out whenever they want. So this feels like a single family home, but it's a 650 to 1,000 square foot unit. It is an apartment. And that was one of the things that attracted me to this business originally, was that it looks like single family and it builds like single family. So it's very efficient to produce these units, but they operate and are capitalized like an apartment. So I knew the access to the institutional capital market, which was generally speaking most attractive, was how I could actually get this company off the ground quickly, which is effectively what we did.
Sure. And so where are these markets, and what makes a good market for a product like this?
So it's interesting. These are generally fairly low density communities. So we build 10 to call it 12 units per acre. A traditional apartment complex might be twice that, maybe 4 times that. So on a land price basis, we generally speaking are looking into the suburban communities. But as Danny said, we're really not looking into the path of growth communities. He mentioned he's doing an analysis of the first apartment in a 50,000 unit or resident community. That probably wouldn't be something we'd be looking for, but we might be within an established community. The sorts of things we look for are transportation corridors nearby. We want to be within a mile of a freeway. We want there to be a fairly sizable job base within about a 10-minute drive. We want there to be services, various types of services with the exception of one. And the services we want are, restaurants and bars and shopping and all that kind of stuff. What we don't care about is schools. And I don't mean that flippantly. I mean, we'd love to be in a great school district. It's just not one of our primary underwriting concerns. Because again, we have very few children in our communities.
Sure. And so tell me about how you go about structuring all this from an investment standpoint, and you don't have to get into the secrets and if there's any innovations around that, but how do you structure all this? How do the teams work together? Who manages it? How do you find your investors? I'm really curious about going down that conversation.
Yeah, so these things are very expensive. They generally speaking, depending on the size of the deal, they could be north of $50 million per deal.
Okay.
So depending on how how comfortable you are with taking on debt, a lot of that might have to come from partners or equity.
Sure.
So, and I assume you had the whole capital stack conversation yesterday, so I'll just flip forward and say how we did it. The way we did it initially was we had some, call it quasi-institutional partners that were interested in doing this business. But their partners, the true limited partners that had the big checkbooks, didn't want to do it. So it was a few individuals that initially started with me, and after getting our first one underwritten, they looked at this and said, my gosh, this is expensive. We need to get a lot more money quickly if we want to scale this business. So we ended up bringing on a high net worth individual. That wasn't a traditional path, but 2-3 years ago, the institutional markets were scratching their heads going, what is this stuff you're doing? And they didn't want to be a first mover. They didn't want to take the development risk. They overpriced the risk of our deals. So you kind of needed a high net worth individual or somebody like that. And the first 4 or 5 movers in this space all had that, including us. So we brought on a high net worth person who did the majority of our equity for the first 3 deals. Once we got past that and had a little bit of a track record, we were able to raise more traditional New York-based institutional equity.
And take me through that conversation, getting that high net worth. I mean, obviously your background is impressive and you have relationships in place and all of that matters, right?
It does.
To have that conversation.
It does up to a point.
Up to a point.
And then at one point or another, high net worth people they'll do whatever they want to do.
Right.
There's a funny term that I've been throwing around called billionaire's prerogative, which means they do whatever they want, whenever they want. It doesn't matter what you say or what the next person says or what they read. It's what they want to do. And that's true. But that said, the process was, there was a lot of gut feel. And there's a lot more gut feel with an investor like that than there is hard data associated with the institutional market.
Nobody's done this before, right?
Right. Well, there was a few that had done it.
But not at
this scale. And one had done it at scale. Actually, 2 had done it at scale, but not really the full breadth of the underwriting that we had said. We said we're going to build these, lease them up, wait a year, and then sell them. And the first operators had just started to sell some of these. One of my, I guess you would say, a group I try to emulate out there, they had sold their first 3 communities in 2018. So there was an example in the market. One example, which, by the way, doesn't make a trend or anything.
Right.
But it was one example, and we said, look, it's been done. Let's go do it.
Yeah.
And, of course, our investor is an entrepreneur, and he was very open to extrapolating, which he did. And he believed in us, and he apparently liked us enough to stick with us. And, to this day, he's still there, which is great.
Amazing. Yeah, that's great. And so what do you see with the product? Even Danny talked about, it'll be interesting to watch how even the product within the build-to-rent model evolves.
Yeah.
Is it too early to tell?
No, but we're collecting a lot of data every week, quite frankly, from our renters to find out what do they want, what do they like, what do they don't like. And we're collecting enough information now where we can start making adjustments to our product. But generally speaking, what we're finding our renters love is they love having their own space. They do not want a neighbor above them or below them,
Sure.
or to the side of them. And if you've ever lived in an apartment, or most of us have, we've all had that neighbor that either smokes too much pot
Parking.
or they're too loud and they like to play Led Zeppelin at 3 a.m., right? And by the way, I love Led Zeppelin. But that's probably not ideal if you have to get up at 6 a.m. for a conference call. So our units provide that privacy. And so they're motivated by the privacy. They're motivated by having their own yard. They love having a barbecue. And the fact that 60% of our renters have a dog because it's real easy to have a dog when you've got your own private patio and a dog door. That's pretty unique. What our tenants aren't primarily driven by is the collection space, the common area amenities. We provide a great event lawn, we provide a pool and a spa and all that, and tenants like it. But the real amenity of these communities is the fact that they've got their own four walls.
Yeah,
and that's what they like, especially in today's world when that might be their office as well.
Are you tracking what the traditional, apartment, vertical model challenges that residents have? I mean, they're obvious in many cases because if you're an apartment operator, I'm giving notice, I'm moving because of some of these reasons, right?
Yep.
Or they're buying a house, so you're sort of sandwiched in between. It's like, I'm going to improve your life and give you what you want here, but you don't have to do the down payment and all that kind of stuff. I mean,
right.
In terms of risk, are you sort of protected in sort of between that home buyer and A-class renter?
Well, it's interesting because what we saw during COVID is the concept of getting to your third floor unit from the garage in a traditional apartment meant you had to touch several different places that had common touch points, elevator buttons, doors to get in, etc.
Right.
And then you'd have to walk down a common hallway where we might have to walk next to your neighbor. And it was a big turnoff during COVID. Now, COVID is, let's just say, mostly in the past. But the advantage to our units relative to that is, well, there's one touch point, and it's your own door. So you really don't have the concerns, the common area
Less
concerns.
friction even.
There's less friction. However, today, as that's gone away, that, I think, was an overstated concern in the apartment business. The apartments are doing just fine, primarily for the reasons that Danny just said. There's a huge undersupply.
Yeah, it's nowhere.
And just speaking for a second of supply, because I'm guessing you're going to ask me that question on this product. When I was on the analytical side, I was constantly getting questions about, are you concerned about the oversupply of these 1 and 2 bedroom detached horizontal apartments? And this was 3 years ago. And the answer I give back then is, well, in an aggregate basis, well, maybe there's, call it 2,000 of these things built and 5,000 of these things proposed. So people were very concerned about that. And I'd say there's 350,000 apartments in Metro Phoenix. No, I'm not concerned at all in aggregate. But I could point to an individual intersection where there's 3 of these communities on the 4 corners. So am I concerned about that geography? Yes. Because nobody knows the future. In that particular situation, all 3 of those were high performing and did great. Because as it turns out, there's a great undersupply of this product as well as apartments. So looking forward, I think we've got a long runway in this space because, quite frankly, the tenants are gravitating towards it.
Yeah, and that makes for a great, stable investment opportunity when you have that recurring revenue. What about the exit part? Like, how do you take something like this full cycle?
Yep.
Can you? And I know your background in lot development, right? Like, how do you see all of this? And is it different from what even others are doing?
Yeah. So it's interesting. In today's environment, there's a lot of threats of tax increases. And so your investors who have tax concerns, it depends on what type of investors they are. Mine, high net worth, have pretty significant tax consequences to investments they make. So they may be less interested in an exit, which would be a sale to call it a big institution, where they'd capture a great deal of taxable income at one time, versus call it a recapitalization and a longer term hold, where they can perhaps pay off their debt, pay down some of their equity, and then hold it, getting monthly checks. That's much more tax efficient. That's my preference. I would love to do things that way. It does depend to some degree on what your investors want. On the institutional side, they're all driven by IRR. So that means you have to sell. Right. So that's the way we've underwritten and expect to do those projects.
Yeah. And it sounds like you have some smart people around you.
Yeah, there's some smart people, that's for sure.
Yeah. What are the things that, I guess, keep you up at night, though? I mean, is anything that concerns you or
yeah.
As an entrepreneur, I mean, we're kind of geared to always have that mindset. That's what you do when you go into these things. But what are you thinking about today, I guess?
So I guess some of my biggest concerns, right now, all of our projects, all 5 of the projects we have going in Phoenix are here in Phoenix. Ultimately, we'll be in other markets. But what keeps me up at night about Phoenix is I do think there's a lot more runway here. I think there's a lot more demand, and we could probably build another 10 to 20 of these things and be just fine in terms of supply and demand characteristics. As I was explaining to Danny, we bought a project in a city here. It's a suburban city, and closed in April of 2020. So just a little over a year ago now. And that project, we spent right around $3.60 a square foot for the dirt. There's a piece of ground across the street that's on the market now at $12 a foot for the same project, same size, same zoning. I don't believe the market for land went up 4 times in the last 12 months, but that's what's being suggested right now by these land prices. So my big concern is that there are going to be operators who haven't done this before that are going to pay these elevated prices thinking, well, the market's just going to continue to do what it's done, and there's going to be some high-profile mistakes made. And unfortunately, when that happens, and I do believe it will affect all of us. Not necessarily
the herd effect, even.
Yeah, the herd effect, and there's going to be a reputational impact in this asset class, if you will. That keeps me up at night.
Yeah, so let's talk about that. What should we be looking at? Well, first of all, how can somebody even get involved in this? You took this step at some point.
I did.
Is this something, where would someone begin?
So I kind of,
not that you're trying to develop.
I kind of jumped into the ocean, right? No, I jumped into the ocean. I didn't start by walking down the steps of a swimming pool. I jumped right into the ocean with the big boys. And our first project was a very large project, 262 units that we're nearing completion on. But I would say for a more reasonable approach to this might be even starting in the build for rent space, which would include homes. Because I think the concept of building for rent 3 and 4 bedroom homes is a great business model. Primary difference, by the way, between those and what we're doing, besides the tenants, are the 3 and 4 bedroom homes tend to be built on individual lots, legal lots.
Those can be sold.
Those can be sold. The exit optionality is great. And for an individual investor, the capital investment, I think, is much more modest. What we've done is we entitled 262 units on one lot. One legal lot. So it's called a site plan.
That's the horizontal
it's apartments. It's always going to be apartments. That means you're committed to develop and build the whole thing. Once you've started, you're not quitting. If you were to go build a few homes and start renting them, that's a good way to ease into this space, and it requires a lot less capital.
You could phase the development process, phase it,
you can
rent it, stabilize.
Correct. You can. You can certainly do that, and you can use much smaller phases on the traditional homes.
Do you see people doing that now, or is that?
Yeah, and in fact, a lot of the public builders are all looking at that, whether they do it on their own balance sheet or whether they sell units that they build to others, like America's Homes for Rent, which has been a very aggressive buyer of these homes. That's a great strategy, and I think it will continue to be a great strategy.
So when you do apartments, there's the minimum type or minimum amount of units you want to do before you can make a deal happen. Can you do one?
No.
Build to rent?
No. You mean for homes?
On what you're doing?
Oh, yeah. No. So generally speaking, we go in, and because of the way our projects are built, the horizontal, the groundwork, is not really able to be phased. You have to include all of it at once. So from there, I mean, if you're going to put in the infrastructure for 262 units, you don't want to build one unit of apartment. So you've got to build pretty much everything you plan. It's very similar to a traditional vertical apartment. Once you've started, you're committed.
Yeah. And now that you've moved through some of these things after jumping into the ocean here, Are there things that you now know that when you began you didn't know?
Oh gosh, yeah. Learn every
Some
day.
tuition.
Literally every day, I'm learning something new, and that's probably the biggest thing. You think you know something, and then you don't.
You don't know that you don't know.
Yeah, and the scariest part is knowing that you don't know something, right? Because you think you do. But I think the thing that's most surprising to me is actually this incredible demand shift that has come towards us. It's funny, the investors that I'm dealing with think we're doing such a great job, and I'm like, look, don't mistake good luck and good fortune and good timing with doing a good job. Now, we are proper stewards of our assets, and I think we're doing a very good job. But if the market hadn't been so strong, we would be doing as well as we thought, not as well as we are. So the thing that surprised me most is just how much demand has come our way.
Yeah. And so what are you hearing from the people that have moved in and are enjoying this new, how did they see it, I guess?
So it's funny.
That data yet?
Yeah. Oh, yeah, for sure. It's funny. I was at one of our communities, and there was a renter that had just moved in, and he was so excited. He had his whole family, his whole extended family there, and he had apparently referred like 10 more renters to our community because he loved this environment. He'd never lived in anything like it. He loved the fact that he didn't have any neighbors. He had a dog, of course. And he was an ambassador for us. I mean, I should put this guy on payroll. He was amazing. But what I can tell you is people really appreciate the fact that when they close the door, it's their house, and it feels like their house. We offer volume, we offer privacy, we offer a private yard. And so even though they don't have to put down the payment to own a house, and everything inside is taken care of by somebody else, us, they have what they feel like is a home.
Yeah, no, and that's what matters most. You look at some of the things that we enjoy in our normal world of living, from Amazon quick delivery. The life gets better when there's less friction and you give time back.
Yeah.
And an experience, right? I mean,
sure.
And so it's interesting to track like the real estate as that sort of consumer product.
Yeah.
Right? If you were to start a business today, we start with the customer, what friction, how are we going to make their life easier, and all that kind of stuff. And it's exciting to see real estate operators and developers, because we've been wildly successful. I mean, these apartment operators have been cashing $1 million checks, and so it's like, why innovate? Why try something new? And now with this demand, it's interesting where we are trying something new here.
Yeah.
So tell me about, you mentioned earlier about the concern around you're a good steward of the money, you're doing the right things, you're buying, and you've got the capable team around you, but someone else may get excited about that, go out there and sort of get out over their skis and buy land at the wrong price, and then that could get into the marketplace, and other developers may see that as like, stay away from that. Mm-hmm. How do we protect that? Obviously, what you're doing here is a part of that. Education. Mm-hmm. But what should somebody do when they're looking at that land deal before they jump into that ocean?
Yeah.
What are the fundamentals? How do you know when you're overpaying for the land? Mm-hmm. What are those metrics? Is there a reference point for this data as it is in other asset classes?
It's a great question. It's the right question, and the problem is there's not a good answer, and here's why.
Not yet.
Not yet. So when I was on the analytical side, 100% of the operators that tried to do this product had significant budget busts on the horizontal construction, every one of them. And it was because they'd never done it before.
And by the way, on a product that's like, hey, let's try something new, and then overrunning, not a good
For sure, but the appeal is you're building units that are little houses. Every single little house is the same. There's no change orders. You put a framer on site, and those guys can build 20 of these things and in a row, and then they come back the next week and they build the next 20. Or next month, and they build the next 20. And it's the same product. So you don't have to worry about, oh, this one has a pop out over here, or this was a different paint color. It's all the same. And the allure of that, which is extremely efficient, is I can do this because I'm a home builder. Problem is, home builders aren't used to burying underwater stormwater tanks. They don't understand the concept of infrastructure that looks like this. Traditional infrastructure in a single-family subdivision, very different than what we're doing. So that alone was a great learning lesson. But how do we protect ourselves against operators coming in and making the same mistake over and over? You can't. So what's going to happen is, as an operator, I'm going to look and I'm going to see some of these deals happen, and hopefully I'm going to learn from their mistakes. because I've already seen some of the mistakes being made. I just mentioned one on the horizontal work. So we're trying to innovate a little bit in response to consumer demand and do things a little bit differently. But I'm not going to do it in a vacuum. I'm going to do it from the lessons that we've not only learned in the past, but now we're learning now.
Pick up from where you leave off. How are you managing these?
So we're extremely fortunate. I think you know John Carlson. John Carlson
yes.
at Mark Taylor is the one that we've been using his company to lease and manage our communities. I think they're best in class at what they do. They probably have as much, if not more, experience with this type of product. So we've had a tremendous relationship with them, and they're doing a great job for us.
Yeah. So just you don't have to have. So having that operating partner is critical in that. How early do you get them involved?
As soon as we've closed on the land, or even before sometimes. Oftentimes, they've got such a great database that they'll help us understand what the rents ought to be, even though it might be 2 years down the road. So when we're underwriting whether a project is financially feasible, they're in the beginning. They're coming in and helping us. And then they really start to get involved about 6 months prior to us having something to deliver.
Yeah. Are you seeing anything around the unit itself in terms of smart home tech or innovation, and maybe even to the extent of, that's on the consumer side of it, but maybe even to the extent of the building of it, the reducing the cost? I know, I think I read something that Elon Musk sold all of his real estate and he's living in a $50,000 property, but nobody said it was like this built innovation, hub. That's,
Yeah. And by the way, I don't believe that, but I read the same.
It's in the news.
It's in the news, right? So smart home technology is really, really significant to us. In fact, that's one of our differentiating factors.
This is like access control.
Access controls, doorbell camera. I mean, it's, from your phone and app, you can control everything from the lights to the thermostat, et cetera. But what we did, I think, a little bit differently than most is before we actually built any of these communities, we installed fiber optic units or cable to every single unit. Most will have fiber to the community, and then it'll stub out
to the curb, but this is to the door.
The door. So that means that as internet speeds go from 1 gig to 10 gigs, you can benefit from that in your individual unit. So working from home in one of our units is kind of future-proofed. That's what we like to say.
Yeah.
And that's one of the things that we spent a lot of time and money doing, but that was an upfront investment that, to retrofit something that's already been built would be nearly impossible.
And having that investor on board, having a long-term vision helps with that conversation, right? I mean, because we've learned a lot in the multifamily space around, from cable to Wi-Fi to now these conversations. I mean, streaming services. It used to be just Netflix. Now it's like Disney and NBC, like everybody's streaming, and so there's more going through that pipe.
Absolutely.
Yeah.
And in a traditional apartment, if the 3 other people on your floor are all working from home on Zoom calls, your Zoom is going to be compromised in terms of how much, or your internet speed is going to be compromised because everybody else is pulling from the same line. Well, in this case, it's not. It's
so on the resume now, it's like I have fiber.
Exactly. It's on our website. You bet. So, absolutely.
Very good. Very good. Pretty interesting. And so what about the construction side of you? And it may be too early to even talk about, but are you looking at anything around sort of that modular process or there's a lot of pretty cool innovations around that. Are you thinking about any of that stuff yet?
There's absolutely no question in my mind that there's a better way to build houses and these apartments. There's absolutely a better way. And one of the things that's unique about my partner is that he had created a company effectively started in 1989, sold it in 2018. And what he did in that time period was took a more traditional manufacturing process, completely changed it and made it so much better, and effectively became the largest provider of cabinets in the United States, actually maybe even the world. Today, he's looking at me going, there's got to be a better way, right? Yeah. So I think the answer is yes. What is that better way? Not sure yet, but stay tuned.
At our Innovation Summit, we talked about first principle thinking, and part of that was, and I picked on Elon Musk because it's easy,
Sure.
And in a favorable way. And we had this maze, and we had people go through this maze, and I think it was one of those brain teasers. Mm-hmm. There was a show somewhere, one of the streaming platforms. And we see something, we take the same approach? Well, Elon Musk talks about first principle thinking. It comes back from like the engineering sort of mindset of really the raw materials. If you look at NASA, smart people, bright, funded, putting rockets into space and, launching rockets, and then the rockets explode, millions of dollars. And so when you think from that first principle thinking of what Elon talks about, first principle thinking is not thinking from analogy. And that means what everyone else has done before you, how it's been done. It's sort of that herd effect, right? Well, they did it like this. Let's make it just a little bit better, just a little bit incremental design. And so he's talking about if you really want to get the customer of tomorrow, it's got to be wildly different. It's got to be really something that stands out. I think Apple was like, there's no keyboard,
Right.
This is the stylus, right?
Yeah.
And so, I don't even need the pen. I just eliminated the thing, or the stylus. I don't need the thing in the middle. And so really thinking from this analogy, all of us do it. And he talks about our brains would be taxed if we didn't. That's how we get here. But, launching a rocket, I think he's able to do it for like 2% of what, they did before, because he's reusing the rocket.
Yep.
It's like, well, if we couldn't blow it up, like how else, so you start thinking that way. And my analogy was to Airbnb, even though this is probably not the story of how they grew and scaled. But for guys like us, if we're like, hey, let's be the largest hoteler in the world, we'd be like, okay, let's get some debt, let's get some investors. We're going to need to buy that company and find deals and buy land or develop it. And that's sort of ruling from analogy, like how everyone else did it, a little bit different, whatever. And so the question is the thinking process before you start. We're trained to sort of have a problem, jump into the solve. Instead of jumping into the solve, think with this first principle thinking. And it would be, well, if we wanted to be the largest hoteler in the world, how would we do that without debt, without getting capital partners, without buying the real estate, right? And it would be, well, let's build a tech, so now they're literally like the largest hotel in the world without owning real estate, having the debt and all that stuff. And so it's fascinating to me to see how we think about the expectation of the customer and the process by which we get there. And you've triggered a few elements of that thinking just in how you're approaching all of this. It's really refreshing to have you here.
Well, thanks. It's great to be here.
Yeah. We're coming up a little bit on the end of our show here. Any final thoughts you want to leave our viewers with?
Yeah, I think to echo what Danny said earlier, this call it build for rent asset class is here to stay. I don't think it's a flash in the pan. I would have said 5 years ago, stay tuned, don't know. But one of the biggest hurdles we have in this space is helping municipal governments understand what we are and what we do. And all we're trying to do is provide a better living environment for the tenants. It's something I think which is a step up. A lot of people appreciate it and like it and want to live here. It is an in-between step between those that can, perhaps afford a home and those that can't but are relegated to apartments, maybe have a little bit more income than a traditional apartment. So it's something in the middle. They want to live near their jobs. They want to spend money in their local communities. One of the great advantages of our product is cities hate traffic and they hate high density or high rise, anything over 3 stories. They don't want people looking at others' backyard. Yeah, we're 1 story and we're low density. So we provide a great product, but still cities just don't understand what we are. So once we can get past that hurdle, and it's not just here in Phoenix, Phoenix is perhaps a bit of an innovator in this product and maybe the furthest along, but going into other geographies throughout the U.S., most cities just look at us and say, I don't understand what you are. So the answer is no.
Right.
That's a problem.
Comes back to story. And I like what you said, making life better for the resident. I mean, ultimately, if you win that, you win everything.
That's what we're trying to do.
I mean,
it's all about the
customer. Spend time in the community, they're living, and fulfilling and enriching their own lives. And that's good for anything.
Yeah.
Everybody, investors and all.
You bet.
Well, appreciate you coming in.
Absolutely.
I would love to have you back. I'm
sure
we're going to be doing a lot more stuff. And appreciate your time here today.
Of course.
All right.
Thanks
we'll see you in the next show.
All right.
All right.